Hey guys, how's it going? My name is Jason Sari. I'm a financial advisor with the Premier Client Group. On the side, I run this YouTube page and a Facebook group called Financial Education for Retirement just to help foster financial education in anybody I can reach. But let's get into the video today on short-term capital gains versus long-term capital gains. Before you understand what short-term and long-term capital gains are, you need to understand where they come from. Now, when you sell a stock in a traditional brokerage account, in an IRA, this does not happen. In a 401k, this does not happen. You get to trade tax-free in those accounts. But in a traditional brokerage account, when you sell a stock, you either take a gain or a loss. If you make money, you take a gain. If you lose money, you take a loss. Now, this loss or gain is tax or deductible. So if you sell a stock for a $3,000 gain, you are going to get taxed on that gain when you sell it in a brokerage account. Again, in an IRA and 401k, you do not get taxed when you sell stocks, ETFs, mutual funds, whatever it may be. But in a traditional brokerage account, when you sell a stock, ETF, mutual fund, index fund, whatever it might be, at a gain, you will get taxed. Now, how you figure out the tax rate is where short-term capital gains and long-term capital gains comes into play. If you've held your position for a year or more, that is a long-term capital gain or a long-term capital loss. If you held it for less than a year, it is a short-term capital gain or a short-term capital loss. Now, how you calculate the tax rate is based off of these classifications of short-term capital gain or long-term capital gain. For short-term capital gain, it is calculated as your ordinary income tax rate that you get taxed at from your normal income. So if you sell a stock for a $3,000 gain, it is taxed at your normal income rate if it is a short-term capital gain. Now, for long-term capital gain, that is also calculated based on income to an extent, but is at a lower rate than your ordinary tax rate. So there's a couple thresholds I'll put up in the corner, but they are the rates that you can get taxed at for long-term capital gains, depending on how much money you make. But there is the chance, as you can see, that you might not have to pay any tax at all if you are in a low enough income tax bracket. Now, as for losses, totally different story. For short-term capital losses, if you've sold a stock at a loss and you held it for less than a year, you can deduct up to 3,000 of that to your ordinary income. So you don't get taxed on $3,000 of your ordinary income if you deduct short-term capital losses against it. For long-term capital losses and short-term capital losses, you can carry them forward indefinitely. So if you have $30,000 of short-term capital loss this year, but you haven't sold any stocks to cancel out the gain with, and you can only deduct $3,000 from your ordinary income, you can save the remaining $27,000 or whatever that amount may be to next year to deduct, or the year after that, or the year after that, or the year after that. There's no limit on how long you can carry forward losses. It is completely indefinite. Another thing you can do with short-term capital losses is take them against gains. So if you have $10,000 of long-term capital gains in a year and $3,000 of short-term capital gains in a year, but you have $13,000 of short-term capital losses, you would be net equal for the year if you realize both the gain and the losses, and you wouldn't have to pay tax on anything. Now, the key word in that sentence is realized. Realized means you sold the position. If you don't sell a position, you aren't getting taxed on the gains and you cannot deduct the losses. They just stay in that position until you sell. Now, if you sell, you do realize them, and then you are able to take these short-term capital gains, short-term capital losses, long-term capital gains, long-term capital losses. But until you sell the position, nothing happens. Moving on to long-term capital losses, you cannot deduct these from your ordinary income. You can only take them to offset gains on stock positions. They are also carried forward indefinitely, but you cannot take them against your ordinary income whatsoever. So the concept of taking gains and losses efficiently and trying to be tax neutral in a portfolio is called tax loss harvesting. I have another video that gets more in depth on that just so you can be as efficient as possible in your brokerage account, but I'll attach that to the end of this video. Otherwise, guys, I hope you learned a little today. I know it was a lot of information for a short video. Feel free to check out the rest of the videos on the channel, like and subscribe, and definitely, if you have any questions, check out the Facebook group Financial Education for Retirement. A bunch of certified financial planners are members that are willing to answer any questions you guys might have. But see you guys later. Have a good rest of your day.